Hi, I'm Justin Miller, co-founder and principal at the Chong Miller Group. At the Chong Miller Group, we're a Las Vegas-based real estate team. We help investors as well as final buyers and sellers buy and sell homes here in the Las Vegas Valley. I also monthly publish a market update on single-family homes and a companion market update on condos and townhomes. And once a year, I publish my market forecast for what I believe is going to be happening in the coming year. So as I record this, it is mid-December. We're looking forward in time. We are looking at 2023. Now, before I dive into some of the interesting data on which I'm predicating my analysis and my forecasts, let me talk just very briefly, for those of you who do not yet know me, about my background. I am a former business school professor, taught for 10 years at University of Southern California's Marshall School of Business and at the Ohio State University's Fisher College of Business. I got my PhD in business, concentrating on financial entrepreneurship and management at NYU's Stern School of Business. I've also been a visiting scholar at the Cass Business School in London. A few years ago, I left academia, but decided to pursue a career in real estate. Real estate's been a passion of mine for decades, making investments on my own behalf, and I decided to bring my knowledge, my expertise, as well as my background to help others with their real estate adventures, whether those others were investors or final buyers or final sellers looking to move into a home. Why real estate? Well, it actually turns out that real estate is one of the only paths that the average person can have that may lead to substantial change in the position that they have socioeconomically. Property values over long periods of time tend to appreciate at greater than the rate of inflation. So that means that properties are actually great hedges against inflation. They tend to appreciate, depending on the market, the demand profile for the particular market, at 4 to 5%. That's over very long periods of time. If your money is growing in a savings account at 1/10 of 1%, if you look at other asset classes, we see some asset classes go up a little bit more quickly, such as stocks. We see other asset classes hold steady in the face of inflation or go down a little bit. So for example, long-term, gold is actually a bad investment because inflation eats away at the price of gold and gold does not pay any kind of return. Property values, on the other hand, go up, and property values, very interestingly, are treated differently in the tax code than almost anything else. In fact, the US tax code treats property owners disparately from how they treat non-property owners. This is true on primary residences. This is even more true as owners of rental property. So buying into property, holding property, is a way to make a return on your money that allows you potentially to gain significantly in terms of your socioeconomic status. On the other hand, buying property and selling property is complex. It's complex for a wide variety of reasons that date back literally hundreds of years. It is not something that one can well do on their own. People need professional representation. And people like me who have experience as investors, as owners of both primary residences and as being a landlord, and as selling those properties, whether those are investment or primary resident properties, allows somebody to have a significant leg up on what they might otherwise be able to achieve. So this is actually a lot of fun for me. I get to play in a space that's of great meaning to me, that's of great meaning to the clients with whom I work. I get to help them succeed as real estate owners, investors, sellers, make substantial returns on their equity. on the investments that they make. And let me just say, so I've been doing this professionally for 4 years, but in the approximately 30 years that I've been investing in real estate, I've never once lost money for myself or for my clients. And it's not that it's impossible to lose money in real estate. People manage to do that all the time. It's because I bring all the analytical tools to bear on the issues at hand to figure out what is actually going to be most successful. So with my background, let me dive into a couple of things. In preparation for making my predictions as to what's going to happen in the Las Vegas real estate market in 2023. So the first thing I want to talk about is there's a tremendous amount of doom and gloom from the commentariat out there. Most of the YouTube videos that you'll watch, much of the commentary that comes across through the newspapers, that comes across through blogs, very negative. People talking about how the market's going to crash, how this is just like 2008 all over again, that we've peaked, we're going to be coming way down, and that buyers should therefore wait. Don't believe any of it. The people who are telling you that, they're telling you that because they want to be listened to. And the easiest way to be listened to is to say the same thing that everyone else is saying, just in more extreme form. If other people are saying the market's going down, say the market's going to crash. If other people are going to say that the market's crashing, say people will be annihilated. If people are saying stay by the sidelines, keep your money available because there'll be great opportunities, say now's the time to wait, don't get into real estate, you will lose everything. Well, in reality, we don't live in a world that tends to be operating at the extremes. Things are super amazing or things are super depressing. That's not really the way that the world works. We tend to be somewhere between those extremes. And so when people are talking to you and you're listening and they're talking about how extreme things are going to be, it's a really good sign to not listen to them. I was talking to my brother the other day. He told me real estate values are going down at least 40%. Now, he's the same guy who told me in April of 2020 that real estate values were going down 21%, when I was predicting real estate prices, sold units, were actually going to be going higher. And I see something similar right now. So we'll get into that in a few minutes, but let me talk about all of the issues that I'm paying attention to in the background. Beyond the commentariat, there are people who are actual participants in this market. People who may be real estate agents, people who may be investors, people who may be purchasers of primary residences or sellers of primary residences. And when I go around and I talk to different market participants, I'm getting a somewhat different view. Now, I'm not going to tell you that everybody out there is sanguine about the environment, that they're all feeling optimistic about the environment, because that's not true. There's a lot of fear, and legitimately, there's a lot of fear. There are so many people talking fear and loathing in Las Vegas that you have to pay attention to it. But over the past 2 weeks, I've been at multiple investor conferences. Now, I know some of you are thinking The Big Short and all those real estate investor conferences that used to happen in Las Vegas just prior to the market collapse in 2008. And in fact, here in Las Vegas, prior to the housing market collapse in 2006. These weren't those kinds of conferences. These were conferences that were of people who were actually investing their own money, mostly what might be called mom and pop investors, who had come to Las Vegas to meet with the law firm that represents them, or with an asset manager that represents them, to look at the kinds of things that may be going on forward in time, including how to protect their assets, how to make sure they don't engage in highly risky activities that may cause them to lose a lot of what they've accumulated over the lifetime of their investing. These investors, on average, had decades of experience in investing in real estate, as well as investing in many other forms of activity. Now, I have my belief about the market, and I'll share that with you soon. But if you've been paying attention to my market update videos throughout 2022, you know that I've been pretty confident about the state of the market, about what we're seeing and what we're likely to see going forward in time. But those market updates are of short time windows, right? And now we're going to be looking for the entire year going forward. Well, it was really interesting to hear almost all of these investors. Now, some of them actually have been watching my videos, which I thought actually was kind of interesting. One's from New York City, and she's been watching my videos. It's like, oh, that's really nice. But they all had similar understandings about the market as to what I had. And so it's nice to find that while in the YouTube universe, I'm definitely an outlier in my beliefs, in the investor community, I'm less of an outlier. And so I'm reflecting what I believe, which happens to be what many of the investors out there are believing. So let me talk just for a second about investor type. Right? And we could classify investors in a whole bunch of different ways, but this is real estate investors. So there have been articles over this past year. Zillow is fleeing the market. iBuyers are departing. They're going all over the place. iBuyers are, generally speaking, larger investors that buy properties for cash. Then they hold those properties and they rent them out. They developed the term iBuyer for instant buyer a couple of years ago. And so that kind of sticks and talks about those types of entities. Well, most iBuyers either are buying and flipping and selling right away. So that's the Zillows of the world. Right? That's what they do when they're buying. Open Door. There are a number of them that you've all heard of. You get their cards and letters in the mail all of the time looking to buy your property because they think they can buy it. They can do a little bit of light renovation, and then they can put it on the market, and they can effectively flip that and make small dollars on every one of those flips. That market has become incredibly difficult because pricing over the past couple of months has come down. So if they were to buy a property, invest additional in rehabilitating that property, and put it onto the market a month later, the prices come down and they may actually end up losing money. So Zillow's pulled back from that activity, and they're not the only ones, but they're the biggest. They are most prominent in terms of the articles that you may read about the collapse of the iBuyers. There's another group of iBuyers, and these are large Wall Street-backed firms. In the Las Vegas Valley, we saw Blackstone come into the market in the 2011 timeframe. And they were not alone. There's some others that came in as well. But these companies were coming in very large, briefcases full of money, buying up whatever they felt like they would be able to buy up and convert into a rental property. They are not buying to flip. They were buying to rehabilitate and hold and put into the rental market. Now, kind of interesting, when these investment banks and investment firms, some hedge funds, some private equity funds, decided to engage in that purchasing activity in the 2011 timeframe. They went to Wall Street, they went to accredited investors, which you could think of as meaning wealthy people, and they created basically private equity funds, partnerships that would put money into a large portfolio that could then be converted into properties. Well, private equity funds have a lot of great things about them, but they have one really significant problem. Private equity funds expire. They have to give the money back to their limited partners, their investors. Typically, they expire in about 7 years. So Blackstone Blackstone, some of these others, decided they needed to convert their rental portfolio of single-family homes that they were buying up if they wanted to hold them for longer periods of time. And it turned out they quickly learned, wow, this is a great business being a residential landlord. It was novel at the time. There was very little large institutional investment into single-family houses in the 2011-2012 timeframe or prior. Institutions, especially life insurance companies, may own very large residential apartment buildings, but the single-family home space had largely been devoid of large institutional investors. But these same investors found, well, that rent stream is really nice. And the property values themselves were going up. And that meant that these institutional investors could potentially go out and borrow additional money using leverage to buy up even more properties. And so they decided to do something. They decided to issue stock. And so Innovation Homes was created. And again, not the only one. Innovation Homes bought out the positions in the private equity funds, allowing these investment firms to acquire and hold on to for an indefinite period of time these single-family rental properties. And these same institutional investors, have decided to keep those portfolio properties. They're not releasing them into inventory to be sold because they're so valuable as cash streams. And B, they've decided they like this business so much, they're actually right now, at the end of 2022, raising hundreds of millions of additional dollars, new money, to be able to double down to do the exact same thing going forward. Now, some of these banks, some of these institutions are quietly talking down the market, hoping they're going to get a little bit better deal, but they're on the sidelines ready to pounce. Now, that means a lot of people, especially here in Las Vegas, because Las Vegas housing prices in the housing crisis, the financial crisis, 2008 to 2012, again here, 2006 to 2012, saw significant there were significant declines in the market, and there have been significant increases in the market since then. So the returns have been really great, but a lot of people became very scared and ended up becoming renters. And so a lot of people are out there renting these multiple thousands of homes in the Las Vegas Valley from these large institutional investors. And every month they write a check to Innovation Homes or whatever other large institutional investor happens to have bought and fixed and now act as landlord on those properties. But that's not who most landlords are. That's not who most investors are. And so when we talk about investors, we can easily start to become confused. The next category of investors are those that hold between about 100 and 1,000 units of property, right? You've got your large institutions, they're holding 1,000 or more units. You've got your next tier, 100 to 1,000. So that tier is being impacted in interesting ways. Those are sort of the open door property trusts, the Zillows. They tend to be flippers. They tend to not buy and hold, which is why they tend not to go over that 1,000 properties. They tend to always maintain a portfolio of properties going in, properties going out on the sales side. They tend to be your flipper type organizations, your Redfins, your Open Doors, your Zillows of the world. Okay, great. We also have another category of investors. These are the ones who hold sort of between 10 and 100 units. They may be professional, but they're smaller in scope. These are your flippers who are going out and looking to acquire a property, to renovate it, and to put it out into the environment for sale. Sometimes they may wholesale properties, so they find someone who wants to sell cheap and they'll find someone who will buy from them instantly for more money. But most of the time, they're flipping and they're trying to offload properties every bit as quickly as they're trying to buy up properties. This category of investors is not attempting to still engage in the business that they're engaged in every single day because it's the only way they make money. This category of investors has kind of taken it on the chin over this past several months because property values are not going up right now in the Las Vegas Valley. And so these investors, the flippers, for lack of a better word, are having a really hard time right now, and they have pulled back. And then there's the large category of investors. These are people who hold, and they're generally people, who hold between 2 and 10 units of property. These are what might be called mom and pops. They tend to be doctors, lawyers, dentists, accountants, architects. These tend to be people who are who work in a profession, who have acquired some amount of assets over the long period of time. They've been working in their highly skilled, highly educated positions, and they've decided that they want to help increase the housing supply, or they want to help keep rents affordable, or they're just looking for ways in which to invest their money in their local communities. Now, some may have a less great way of thinking about that. Some might become kind of negative, but let's look at the percentages of property buyers to compare which category is which. Mom and pop investors tend to be about 13% of the market. 13% of buyers, mom and pop investors. They tend to be the largest landlords as a class. People who hold 1 or 2 or 3 or up to 10 rental properties. The largest group of landlords. This is the group that actually owns, if you're a renter, more likely owns the property that you rent right now than the large institutional investors, unless you live in an apartment building, right, for the single family housing stock. The flippers, they tend to be about 2% of the market. That 2% is really hurting. The sort of larger institutional flippers, the Open Doors and the Zillows, etc., they tend to be about 2% of the market. And the large institutional investors, some of them have accumulated thousands of properties collectively in Las Vegas. They hold about 8% of all single family properties, but they tend to be only about 2% of the market as well. So if you were to take all of those that acquire more than 10 units in a year, all the way up to more than 1,000 units in a year, they still cumulatively amount to only about half of what mom and pop investors are buying. The mom and pop investors, sure, they're impacted by different things. They're definitely impacted by certain new regulatory requirements that may be imposed by legislatures who are not particularly happy with large institutional investors and therefore make decisions that may negatively impact the mom and pop investors. But that 13% of the market, it's still there. Day in and day out, they're making their small property investments. They're turning those property investments into rental properties. They're renting those out. And they're either holding them, or over some period of time, they may sell something and buy a replacement property. There's actually a tax code provision that allows them to move from one house to another with their investment in a way that shelters them from taxes on buy and sell decisions. So the tax code is actually preferential toward small landlords. Well, these small landlords have not left the market. And these small landlords are the types of investors that I was just at a conference with this past week. and another conference the week prior. Very interestingly, this group of investors, the 13% of the market, is pretty optimistic about the way things are going to look in 2023. So given that they are actually the largest group of market participants, that says something about the way that I think the market's likely to shape up in 2023. So with that said, let's talk a little bit about how 2022 looked, because I think that this most recent history will be informative for how we go through the next year. Now, the data I'm going to use in looking at 2022 is going to be single family resale in the Las Vegas Valley. Now, very interestingly, prices have held up remarkably well, and I'm going to show you three versions of the same graph here. In this first version, this looks pretty bleak. Prices have fallen since May from $480,000, which had been a peak, had been record high pricing here in the Las Vegas Valley. Again, median sale price, single family, resale residential. And you can see this has come down. At the end of November of 2022, we had come all the way down, $55,000 down from that peak to $425,000. That sounds kind of bleak, right? It looks like a big steep drop on this chart. In fact, this is a drop of 11.4% that's happened over this past 6 months. Let's pull out a little bit. Let's pull out to look at the full year 2022. And you'll notice something kind of interesting. This looks almost like an N or an inverted U. This chart shows we started January 1st, 2022, single family median resale price, $425,000. We'd gone up. At the end of May, we'd gotten to $480,000, as I just said. At the end of November, we'd come all the way back down to $425,000. That means over the first 11 months in their entirety, so what's that, 334 days of 2022, we effectively were flat. Now, we went on a bit of a roller coaster ride. We went up and then we came back down, but we are flat over the first 334 days of 2022. Now, that's kind of interesting, because we've been hearing about how bad the market is, and we've actually been flat. If you held property coming into the year 2022, you've not lost anything. If you bought in the first 6 months of 2022, we've come down a little bit. But if you had bought with a standard conventional loan, 20% down, even at the very peak, you still have equity in your home, which is a really interesting point. Now, I'll do a little more on that equity issue in a minute, but let's pull back further. Let's pull all the way back to look at a chart that goes back to 2012. Over the prior 11 years, 2010, 11, etc., through 2022, you can see there's a very strong trend in pricing for single-family resale homes in the Las Vegas Valley. And when I say pricing, I don't mean the price that people are asking, I mean sold price. The median prices we're looking at now are not what people are asking for houses. This is what people are paying for houses. And you can see we've been on this strong uptrend, and we've, over the past 6 months, had a correction in that uptrend. So we are now below trend. We are now headed down, but we were only down 11.4% when we've gone up very considerably over the past year, 2021, 2020, 2019, etc., etc. Some years we go up more quickly, some years we go up less quickly, some years are a little above trend, some years are a little below trend. Clearly, on the whole, 2022 is going to be a below trend growth year. we're flat for this year, at least so far. Now, December will give us what December gives us, and we may end up being up slightly, down slightly. It's not going to change very much from where it is. We may still be perfectly flat. So we've got a strong, more than decade-long uptrend in pricing. And in fact, this is what happens with real estate pricing generally. We get uptrends. They're long duration secular trends in pricing that takes us up 4 to 5%, again, depending on what market we're in. A high growth environment where we get lots of new employees coming in, lots of new residents coming in, as we have in Las Vegas, we tend to be on the higher side of that long-term growth trajectory in real estate pricing. And so that's what we've been doing, is we've been growing at this solid pace over the past decade. And right now we're correcting from that. We're not crashing. We're not going down substantially. We've given back 6 months of the uptrend. That's all we've done over the last 6 months, actually over the last 5 months. We've given back the 6 months of growth that we had at the beginning half of 2022. Now, some people will look at the chart and they'll become very scared because there's a psychological processing mechanism. The way in which people deal with certain types of information is through a series of what are referred to as heuristics, shortcuts to the processing of information. And some heuristics are very strong. They're methods of coping with information which are biologically derived. The human mind uses heuristics to focus through certain types of information to protect itself. So, for example, if you're attacked by or almost going to be attacked by a lion in the forest, right, you want to pay very careful attention to certain things as you're walking through a forest. It doesn't matter if you've done it before or you've not done it before, if you've ever heard a story, you have not heard a story. There are ways in which your mind focuses on certain types of information as a threat reduction mechanism or as a coping mechanism to sort through large volumes of information. And by the way, these heuristics are Nobel Prize winning research that had been done back in the 70s. One of the strongest heuristics there is an availability heuristic. If we think back across times of our own individual experience, we look for something that appears similar to what we're looking at right now to quickly eliminate contrasting data and to make available to us the further knowledge about what may happen in the future and therefore the response that's valid. Well, the last time housing prices went down here in the Las Vegas Valley started in 2006. And so a lot of people look at this data and they immediately go to the idea, we're going to go into a housing crash. We're going to lose 70%, 65% of the value of housing in the Las Vegas Valley. Well, let me tell you why that's not going to happen. Why the heuristic is actually misleading to us. One, in 2006, as we were going into this crisis, what started in Las Vegas and 1 or 2 other markets as a housing crisis, but which actually morphed in October 2008 into a broad financial crisis sparked by the feds allowing Lehman Brothers, a large investment bank, to collapse. That's what created the massive dislocation that we saw across many elements of the US economy, especially including housing. Now, do we have that situation now? No. Why? Well, A, most people had very little equity in their houses as we went into this financial crisis. Many people, in fact, were underwater on their houses. Now, in May of 2022, we actually have greater homeowner equity than at any time in the history of the US. Now, some individual homeowners might not be in such a great equity position. If you bought in May of 2022, the value of your house is probably a little bit down. If you put in a 20% mortgage, you have equity, but your equity position is going to be 8.5% or thereabouts. That's it. That's still not bad. You don't want to sell necessarily if you're at 8%, but it's still not bad, right? It's a whole lot better than being underwater, which was a term that you heard a lot back in the financial crisis. All right, next thing. Many people in 2008, 2006, going into the financial crisis, had adjustable rate mortgages. Now, there's nothing at all wrong with an adjustable rate mortgage. They can be really valuable and viable products. But a lot of the adjustable rate mortgages that existed at that time were not highly regulated, and therefore they started with teaser rates that might be like 1% for a year or 2 years, 3 years, that would then quickly reset to the base rate, which might be 5 or 6%, and then reset after that to whatever the background interest rate may have become. So 3-year ARMs were very prominent. 3-year ARMs with teaser rates, very prominent. And so those resets came quickly, and they could dramatically reset the amount of payment that one was going to have to make on a mortgage. Right now, most, I don't know what the actual current statistic is, but it's well over 85% of houses that are being bought with mortgages are being bought with fixed rate mortgages. Fixed rate mortgages do not have resets. Doesn't matter what happens to the background interest rate, your rate is fixed in that mortgage. Your price does not change. Now, it may change a little bit depending on what's going on in the escrow account with taxes and insurance, but you're talking $50, maybe $100 of change for the next year, and it may go back down the following year, depending again what happens in the escrow account. But you're not getting these big resets in mortgage interest rates on a fixed rate loan because the interest rate's not resetting. And so you're not going from paying $500 a month to paying $1,200 a month. So your payment is basically fixed. The third thing, most mortgage lenders in the 2006, 2008, the time prior, were writing mortgages based on very low and no documentation required. These are the mortgages that some people refer to as liar loans. If you could write your name, if you could fill in an application saying that you had a job and stating what your income was, nothing was verified, and so you could put down anything you want and you could get a mortgage on a property. Now, you might be making it up. You might be being honest. A lot of people are honest and they're saying the correct things. You had other people out there who were being dishonest and they were getting into mortgages they never should have been in. Those mortgages were then resetting at higher interest rates and they had troubles. As the Federal Reserve in 2004 started increasing interest rates, these liar loans started to become incredibly problematic because they had been written with the belief that people could just simply refinance their loans. If interest rates went up, it didn't matter because you could get into a new liar loan with a low teaser rate as long as the value of your property continued to increase. But when the Fed started to increase interest rates, that caused the price of property to stop going up. And you cannot refinance property that's underwater, so you can only refinance if you've got equity in the house. Inability to refinance meant you were subjected to these high interest payments suddenly that you maybe could not make, and you found yourself losing equity as other people started rushing into the market to sell their homes before they got trapped in the same kind of position. So you had liar loans, you had teaser rates on adjustable rate mortgages, and you had very low equity positions. There's one other thing that you had in that time frame. Builders had been building at incredibly fast rates across the US, and in particular in high growth areas like Las Vegas and Phoenix. And not just Las Vegas and Phoenix, but highly emblematic of the issue. And so we actually had excess houses here in Las Vegas. That's not the case now. Across the country, depending on which version of the statistic you want to look at, we're down between 2.9 and 5 million houses from what we should be at, because building dropped off the cliff in 2007, 8, 9, and we only got back to trend level of building, replacing of houses that burned down or damaged or just become decrepit, building new houses to deal with the new population growth. We only, in the Las Vegas Valley, got back to the trend level of building in 2022, the beginning of this year. Now, we've been therefore below trend level building since 2007, 2008, let's say 2008 in the Las Vegas Valley, more than a decade. We have a housing shortage that's effectively a crisis level of housing shortage. We need 100,000 more homes than what we actually have in the Las Vegas Valley. Now, I know you go driving around the Southwest, the Northwest, the Northeast, parts of the Valley, and you see lots of houses under construction. That's true, there are a lot of houses under construction, but we're not building at the level we need to accommodate the replacement requirements and the new growth requirements for people who are actually moving to the Las Vegas Valley. Now, fortunately, over the past 2 years, we've gotten a lot of new apartment building construction and a lot of new multi-family housing construction, which has helped alleviate some of the problem. But in reality, we do not have enough housing units in the Las Vegas Valley. People have to live somewhere. So how do people deal with that? Well, maybe some live in manufactured housing. Maybe some live with roommates. Maybe some people continue to live with their parents instead of moving out of the house, and we get multi-generational households. Now, is that bad? No, it's not bad. But it's not the way Americans typically seek to form their households and live through their adult years. And so we have, as a society, come up with creative short-term solutions to deal with the lack of housing. But we see increasing levels of homelessness, and we see increasing levels of what some refer to as non-affordability of housing, right? Because if there's not enough houses, prices are going to go higher. If you have plenty of houses, prices don't have to go higher because supply and demand can be in balance. So the long-term secular trend, housing prices goes up 4 to 5%. In the Las Vegas Valley, we're at that sort of 5% long-term secular trend. Housing prices go up because we have population growth, and that's on a background of we have new houses being developed that account for the growth in population within a particular area. And we've been having below population rate growth on housing units. So prices are going up. More recently, over the past 2 or 3 years, at a rate higher than trend. Now, in 2020, we closed the economy, right? Not completely voluntarily. The economy was closed upon us, if that's the way you prefer to say it. And in 2020, in March, and in April, and in May, I stated, and you can go back and you can look at the YouTube videos. We have very tight inventory right now in the Las Vegas Valley, 2.5 months. That's with the lower sales figures that we're seeing, the lower number of transactions. We still only have 2.5 months worth of inventory. If buyers start coming back into the market, we're going to start seeing those numbers of transactions increasing, which is going to dramatically and quickly
impact inventory in terms of months supply to lower that number. Inventory will become tighter and tighter because buyers are looking to buy. We need sellers who are trying to sell their homes. Again, prices are not going down. I think what we're going to actually see is sellers and buyers coming back into the market at approximately equal levels. I think inventory is going to continue to remain very tight. I think that pricing pressures will start to escalate as we get through the next several months.
Now, why did I say that? Everybody else was out there saying housing prices are going to collapse. There is no economy. People can't afford to buy houses. It's getting really bleak out there. My brother told me, down 21%. And I said, no, housing prices are going to go up. Why did I say that? I said that because the demand profile was out there that was telling me that some people would take advantage of the closing to be able to buy houses. Some people, as soon as there was a little bit of reopening, would rush out to get into the kind of house that they wanted to be. Some people would be leaving other places to get into a house that was easier for them to live in, either larger or bigger backyard or lower mortgage payment, whatever it happened to be. And we were going to see a significant uptick in number of transactions and in pricing of units. And I predicted that would continue further into 2021 and actually continued into the first half of 2022. Now, I could refer to that as I was seeing latent demand, is people were being forced out of the housing market for some particular reason, meaning they could not buy. The demand was still there. It was right below the surface. It was latent, meaning not visible, but it was still there. And as soon as people had the ability to buy, they would. Now, of course, interest rates came down at that time as the Federal Reserve fought to underpin the economy so that things would not get much worse as they had allowed to happen in 2008. And it's a really good thing that they did. And that low interest rate money, as well as a lot of additional money that was fiscally pumped in, so government spending, pumped into the economy to give replacement income, to give higher levels of unemployment insurance payments, to give relief checks to not everyone, but a wide segment of society. Those things all supported housing prices. The market went up. Now, we're in a little bit different position now. What's the position that we're in now? The economy is fully reopened. We've had problematic supply chain issues throughout the economy for cars, for employees, for houses, for appliances, for furniture, for clothing, you name it, for gasoline, for food. Those supply chain problems, less supply than demand, caused prices to go up, caused inflation. Now, it's kind of interesting if you're a student of history, if you look at this, it's really surprising that anyone was surprised. It's really funny that anyone was surprised by inflation. The economy in the US had been largely shut down by demand, by fiat, by governmental order. And then the economy reopened. Now, it reopened in a little bit haphazard manner. It was not consistent across states. It was not consistent across localities within states. And obviously people responded and individual businesses responded in moving back into the economy at different rates. But the economy reopened and reopened pretty quickly. Well, in the Navy, we say you cannot turn an aircraft carrier on a dime. You can't stop an aircraft carrier on a dime. You can't start it up either in just a second. It takes time. There's friction, there's momentum, there's the inherent physical qualities and emotion through a medium that require significant changes in force. Well, the same thing is true in the economy. And if we look back, for example, to the end of World War II, so World War II is kind of instructive. The US economy worked differently during World War II than it did before or after. And so we tend to take that reopening after World War II as being the modern economy, and we tend not to look at statistics prior to that time because the US was an agrarian society in the 1930s and prior. In the early 1940s, we became a highly industrialized society. But the economy still worked differently. There were dollars in circulation, but you could not spend dollars on certain things because you could not engage in certain types of commerce freely during World War II. There were rations put in place. Now, dollars in a market economy act as a rationing tool. If something's priced at $10 and someone has only $9, they cannot get that $10 item. If someone has $11, they can get that $10 item. But there's a certain unfairness, some people believe, especially if the number of dollars in circulation are artificially constrained, or if prices are too high in dollar terms because of other artificial constraints. During World War II, butter was rationed, gasoline was rationed, pickles were rationed. I'm not making this up, actually true. You could not buy a car in the US during World War II unless you had a very limited permission set from the government. Steel was rationed, rubber was rationed. If you were driving a car and your tires blew, you may not be able to get new tires for your car for months and months, because tires at that time were made exclusively of rubber, and rubber was rationed. There were a whole host of really significant consequential things that you could simply not buy. Aluminum was rationed. Nylon was rationed. Well, how did you acquire these things, right? If you wanted to have a pickle, how did you go and get that pickle? The government issued ration coupons. No joke, they really did. The ration coupons allowed you to engage in the buying of some things. You could have a coupon that allowed you to buy a limited amount, a few gallons of gasoline. You had a coupon that would allow you to buy certain types of snack food, right? Different ration coupons could be used for different things. Well, the war ended, right? World War II came to an end. The US and the Allies were victorious in Europe and then in Japan. And after the end of World War II, what happened? A couple things. Soldiers returned, sailors returned to the US, and the industrial base of the US was converted to civilian use, the production of civilian products, cars, gasoline for cars, rubber for tires. You could get rubber bands to wrap a newspaper in. As the economy reopened and allowed for dollar expenditures to acquire all of these different things, and as we had returning troops, what else did we have? We had higher rates of inflation. No surprise, we had supply that was completely out of balance with demand. We had a lot of people coming back in who'd been able to store up some money, right? Because they were either deployed overseas and didn't have the ability to spend money because they were being taken care of by the government, or because they were spending their ration coupons on the limited things they could get during World War II and they couldn't spend their cash. So you had people with means and you had supply dislocation. And those people came back into the economy and inflation went quite high. So what happens if you try to reopen a large economy that you had closed, and all of a sudden you get a lot of demand coming in and limited supply to meet that demand? So no surprise, that's what we got is we reopened from the pandemic, from the forced shutdown of the pandemic in 2020. So where are we now? we're in an environment that has higher inflation. Now, inflation is caused by other things too. We get secular shifts in the population. They're actually tied to generational cycles. Some generations are bigger than other generations. Baby boomers had been the largest generational cohort in American history until the millennials. And millennials are now not just coming into real prime spending age, but they are actually the largest generational cohort in American history. Sandwiched between them, my generation, the X generation, and coming after the millennials, the Generation Z, relatively smaller generations in terms of population sizes. And so Gen X and Gen Z have smaller macro economic footprints on the economy than do the baby boomers and the millennials. So the millennials are in their prime spending years. That's inflation inducing. The same thing happened in the 70s when the boomers were in their prime spending years, and we ended up with significant inflation at that time. So we have superimposed on each other both the reopening of the economy and the inflationary issues associated with that, and the generational spending wave that comes from the millennials at this time. That makes inflation endemic in the environment. The Fed is fighting inflation. They want to do everything they can to eliminate inflation. And in all honesty, it's not going to work. They've got too many really, really large-scale forces fighting against them. They cannot. Now, what they can do is they can create a recession. Recession temporarily constrains demand because recessions generally are marked by increasing levels of unemployment. People who are unemployed tend to spend less. People who think they may become unemployed tend to spend less. I was talking to one of my clients a couple weeks ago, and his wife has told him, hold back from making any investments in real estate right now because you could potentially lose your job. So fear of recession can restrain spending, and we're seeing restraints in spending. Now, the Federal Reserve has been very aggressive at pushing interest rates higher. How aggressive? At the beginning of 2022, the Fed funds rate, the policy rate that is set by the US Federal Reserve, the only interest rate in reality that's set by the US Federal Reserve, was at 0%. As I record this, they've just increased the policy rate, the federal funds rate, to 4.5% in mid-December. That's a massive increase, right, on a percentage basis from 0 to 4.5. That's an infinite increase. But even if we'd been at 1, we've more than quadrupled the rate from what we'd been at the beginning of the year. So rates have gone up actually at an historically rapid pace. Rates have been higher in the past. They've never been lower than what they were coming into this tightening cycle, but the actual percentage increase, I mean the number of basis points, 450 basis points, 4.5% from the cycle low to where we are right now in a 1-year period of time, we've not seen that before. This is an historically rapid increase for a prolonged period of time in the policy interest rate in the US economy. Now, the policy rate, the Fed funds rate, is an overnight rate, which is kind of interesting. That's what banks would pay to borrow money for a single night. That's a really short-term rate. Well, there are other rates, there are other interest rates that are really important in the US economy. One of those is the 2-year Treasury. One is a 10-year Treasury. One's the 30-year Treasury, right? The government borrows money, and to do so, they issue bonds, and those bonds pay certain interest rates. Interestingly, if we take the 2-year to 10-year yield curve, the difference in interest that a bond, right? A bond is borrowing on the part of the government, but it pays interest to the lenders. The lenders may be banks, they may be institutions, they may be people. You could go out and you could actually buy a government bond. The rate that the bond pays is derived by what the market demands if they're going to lend the government money for this period of time, right? So there's, in the US, there's a well-functioning, highly clearing bond market, and there are multiple parts of that bond market. So on the treasury bonds, there's the 30-year bonds, the 2-year notes. If the interest rates on 2-year notes end up becoming higher than those on 10-year notes, we refer to that as being an inverted yield curve. Inverted yield curves pay more to borrow in the short term than they do to borrow in the long term. And that's a really clear signal that we're likely going into a recession. Why? Because we've got higher inflation right now, and we're going to end up with lower inflation over time, and maybe even a reduction in demand because of recession. So people will say, well, I'll lend to you for 10 years at, let's make up a number, at 3%, because I know for 10 years, each of those years, I'm getting 3% of my money. But I'm willing to lend you for 2 years only at 4%, because there's going to be inflation over this next 2 years, and I need to get more money back from you. So there's a 2-year to 10-year spread. That's indicative of a coming recession whenever that becomes inverted. Now, it's not 100%. There's a 2-year to 30-year. And when that becomes inverted, that's a much stronger signal of a coming recession. Well, we have right now a yield curve that's inverted across the entire time duration. The overnight lending rate is 4.5%. All of the other bonds after the 2-year bond are below 4% right now, and the 2-year is less than the 4.5% of the policy rate. So the entire yield curve is inverted. That suggests that bond traders, some of the most conservative investors that there are, and some of the most knowledgeable investors there are as a class of investors, are saying there's a recession coming. We also had negative growth in Q1 and Q2, that's Q1 and Q2 of 2022, and it looks like we're going to experience negative growth in Q4 of 2022. Q3, we actually had a little bit of growth, way below normal, but in the 1.5%, 1.6% range. So we're going to end up being negative in totality for overall economic growth during the year 2022. That fits multiple definitions of recession. But recessions have to be officially declared by a small group of academic economists. So we cannot definitively say what that small group of economists will declare, but we're meeting all of the definitions except for significantly increasing unemployment rates of being in a recession. Likely in 2023, we'll be in recession. So we have a shortage of housing. We have high levels of equity in the housing market. We have pretty stable, meaning the majority of owners are sitting in fixed rate mortgages. But we're going into a recession. What does that mean without regard to sort of this year? What does that mean with regard to prices? Generally, when the Fed is increasing interest rates and when we go into recession, so which is actually highly correlated, almost all recessions in the US have taken place in the face of Fed increases in the background or policy interest rate. That usually reduces the level of construction, which causes an increase in the level of housing prices. Which is a little bit problematic, but that's actually the historical result from recessionary forces, is housing prices go up. So we have that issue. There's 2 other pieces of data as related to 2022 that I want to look at before we start talking forward in time in more detail. One is sales volume. the sales volume has dropped really significantly during the year. Now, we had initially been looking at much slower selling than had taken place in 2021, but 2021 was a record volume year. But as we've come into Q4 of 2022, we've actually seen such drop-offs in the sales volume that we have to go back to February of 2008 to see a month that had as few closed sales as what we saw in November of 2022. And the Las Vegas Valley had 27% fewer people in 2008 than it does in 2022. So the sales volume is incredibly low. Interestingly though, with that low sales volume, right, that suggests buyers have sort of left the building. They're not buying. So sales have dropped. But with that low sales volume, prices have remained remarkably steady. Yes, they've come down 11.4% since May, but they're actually totally flat since the beginning of the year. Now, the other piece of data is with regard to inventory. Now, a lot of the places you may read data from, inventory's been spiking, it's been going up amazingly, up multiple hundreds of percents. The claims are bogus, they're wrong, they're actually misstated mathematically, even if you were looking at the data, which itself is incorrect, that these people are talking about. Volume has gone up. It's gone up somewhat, but we're still at 70 to 75%, depending on which portion of the housing market we're looking at, 70 to 75% of normal inventory in the market. And for the past 3 months, a solid trend in place, inventory has been coming down. If we look at new into market, newly listed houses into the market, been coming down for an even longer period of time. We now have a situation where inventory is falling faster, meaning sellers are leaving this market faster than buyers are. We have a seller strike going on in the Las Vegas Valley right now, which is a really interesting thing, right? When buyers go on strike, they don't buy things. When sellers go on strike, they don't sell things, right? We've got sellers who may have been having trouble selling things, but they wanted to. We've got sellers now pulling out of the market. They are literally taking their houses out of the market because they've decided they do not want to sell. Now, some of that is maybe seasonal because we tend to see the smallest inventory levels, the lowest level of newly listed resale properties in the November, December, January timeframe. Our inventory number for single family homes in November was 13.1% lower than the number in October. Really significant decrease in the amount of inventory that's available. We're seeing this in the multifamily segments of condos and townhomes as well. Trend lines in place for decreasing levels of inventory. Sellers have gone on strike. Now, why might that be? Well, a lot of sellers are sitting on positive, nice, comfortable equity positions. A lot of sellers are sitting in mortgages that they had acquired or refinanced to 3%, 2.75%, 2.5%. And if they want to go out and buy a new house now to replace what they already have, they're looking at interest rates that are considerably higher. Sellers are reevaluating their position, and some are deciding, well, it's seasonally slow right now, and so I don't want to be in the market. I'll come back in spring when inventory generally grows because more buyers are out there. Great. But some of those sellers have decided instead to rent out their properties, and those properties will not be available to go into the for sale market because they're rented out. Some sellers have decided, I like my position in my house. I've actually come to terms with, I'm not going to be able to sell it. So I don't want to sell it. I want to stay in it. And they're not going to come back into the market. So this is a really interesting and important point to think of as we look forward. A couple other things. Let's talk about those interest rates. The Federal Reserve, which has increased the policy rate from 0 to 4.5%. Remember those different markets I was talking about, the bond markets. One of the bond markets is the mortgage bond market. And the mortgage bond market, it's a free market where buyers and sellers decide what they're going to pay for mortgages. Not for borrowing of money, but for buying of the mortgages that have been packaged together that are available for bond purchasers to acquire. And as bond purchasers leave the market because they don't want as much, interest rates go higher, right? Price goes down because there are fewer people trying to buy mortgage bonds, mortgage-backed securities. And interest rates work exactly inversely to the price of a bond. So as the price of a bond goes down, the interest rate on that bond goes higher. So we had seen speculation, maybe some level of manipulation in the mortgage-backed securities market within the past several weeks, which had taken mortgage interest rates from what was about 6.25% all the way up to about 7.49%. A great big spike in mortgage interest rates. But that spike, even though the Fed has increased further the policy rate during this time, that spike has now been alleviated. And last week, the bond rate had come down to 6.39%. Come down more than 1% over the prior 3 weeks. That means mortgages have gone well over 7, have now come back down to under 6.5%. Now, kind of interesting that policy rate is in some ways irrelevant, but what becomes really relevant as related to mortgage interest rates is the 10-year Treasury. Because 10-year Treasuries and mortgage rates are highly correlated, and they generally vary by 2%. If I can lend the government money at 3.5%, the government is relatively risk-free. So I'm going to demand more to lend my money to a homeowner. So generally, that's just slightly less than 2%. So if we were at 3.5% on the 10-year Treasury, we should be just below 5.5% on a 30-year fixed-rate mortgage to a homeowner, to a home purchaser. Somehow, we're sitting at about 3.7%. It fluctuates daily, so let's just say generally at about 3.7%. On 10-year Treasuries right now, that means that mortgage interest rates should actually be below 6%, but they had spiked all the way up to just less than 7.5%, and they're coming back down. And they've still got further to go. Mortgage interest rates should actually be just a little below 6% right now, and they're actually about 6.4% right now. So mortgage interest rates likely will come down a little bit further, especially as the Fed slows its pace of increasing rates on the policy rate, on the Fed funds rate. Now, will the Fed stop increasing rates? Yes, certainly at some point. When? I don't know. There'll be a rate increase decision in February, and undoubtedly that will increase the Fed funds rate another 25 to 50 basis points. We'll probably see another increase in March, but I think we're approaching the end of this rate increase cycle. Then the question will be how long the Fed maintains the policy rate at the level that they attain before they start lowering that rate again. And that probably depends on how quickly and or how steeply the economy goes into recession. But rates will come back down, which means that mortgage rates will come back down. Plus, again, mortgage rates had already spiked too high. So I've been saying throughout the year, the mortgage-backed securities market has been overreacting to all of these Fed policy decisions. And every time the Fed moves, there's a spike in mortgage-backed securities interest rates because there's a big drop off in the demand for the pricing for mortgage-backed securities. And then we get that interest rate coming back down and spike again, come back down. This last spike was really quite large. We've come down more than 1 whole point or 100 basis points on the mortgage market since the move in November. And even though the Fed increased by 50 basis points in December, we've still seen mortgage interest rates coming down. So I've been saying over the past year that I think that the interest rate around the end of this year is likely to be pretty close to 6%. And I'm going to stick with that, right? I think that that's correct. I think that the bond market simply reacted violently and too quickly to what the Federal Reserve has done. So mortgages at 6%, they're a lot higher than where they were at 3% at the beginning of 2022. But a lot of market participants are seeing, well, that's a lot better than the 7% they've gotten to. Maybe this isn't quite so bad. Part of what slowed the market this year has been the very rapid increase in interest rates and uncertainty associated with that and several other things, such as the election cycle. Elections are out of the way now. We know what generally is going on with the economy. We're going into a recession. We know what generally is going on with interest rates. The Fed funds rate will continue to go up, but at a slower pace, and that's causing mortgage interest rates to actually come back down. So we're getting some certainty into the market. That will drive buyers back into the market. Now, I had said in 2020, the real question about the reopening from the pandemic was going to be whether buyers come back first or sellers come back first, because that would have a materially significant impact on pricing in the market. And that I believe buyers would come back first. Well, I see from my anecdotal experience being out there in the market every day, talking to buyers and sellers and investors, that there's a lot of latent demand. And the buyers are likely to start coming back into this market as soon as we start to see more clearly what's going on with mortgage interest rates, and certainly as we reach peak mortgage interest rate. Buyers are going to be coming back more quickly than sellers, and this current seller strike is even more convincing to me that that's exactly what's going to happen. What that means is when buyers return, they're looking at less inventory, and we're going to end up in the same kind of situation that we had in 2020. We're going to see prices going up. So what does that mean for my forecast for 2023? Despite what you're hearing from the economists at Redfin, despite what you're hearing from the economists at Zillow, despite what you're hearing from the economists at the FHA, what I'm thinking is going to happen is we're actually going to see buyers coming back into the market. We're going to see buyers coming back into the market before sellers do, which is going to cause prices to go higher. Now, let's put some time parameters around this so that on January 1st, nobody says Justin's all wrong because of actual data. Q1 is not seasonally a strong time of year. We need to get through some additional level of what's going on with regard to the Federal Reserve. We need to get a little bit more clarity around that. We'll never have perfect clarity, but their actions will start to tell us a lot about it, how they're going to continue to address the inflation issues that exist. I think we're probably going to see the end of the tightening cycle, not the beginning of a loosening, but the end of the tightening cycle at the March meeting or within 1 or 2 months thereafter. I think once we see the Federal Reserve stop their increase in the policy rate, that we're going to start to see significant buyer reemergence. And I think that that's going to come about prior to sellers re-entering into the market, which is going to cause a further deterioration in the inventory profile for the housing market here in Las Vegas. I think what that means is that we're going to see upward pricing pressure. Now, when exactly this happens is a little hard to tell because there's some outstanding pieces of information we don't know. But let me say it this way, Q3 and Q4, so the second half of 2023, I think we're going to be seeing increasing sales and increasing prices. I think both sales volume and pricing will be going higher. Now, we'll be inventory constrained, so we cannot grow the number of sales real quickly. But as we saw in the back half of 2020 and through all of 2021, even with low inventory levels, increasing prices can drive some number of sellers into the market to cause them to just very quickly get sales at higher prices. So even though we see sort of static month-to-month inventory, we actually can be attracting in additional sellers that allows for quick sales. So I think that we're going to be seeing that in the second half of 2023. Q1, I think, will continue to be slow. We may see some additional pricing pressures on the downside in Q1, although anecdotally, I'm actually looking at a stronger January than December. I'm seeing some buyer reemergence in the contacts that I have, in the clients who I've been talking with directly over the past couple weeks that look like January should actually start to see, because of a reduction in the level of uncertainty. I think that Q1 should probably be better than Q4 of 2022, but the question really is Q2. What goes on? Do we start to see sellers coming back in more quickly than buyers? Do we start to see buyers rematerializing in Q2 more quickly than sellers? And where exactly that happens in terms of the individual months. So Q2, I think, is going to be a bit transitionary, and I don't know exactly where on that 3-month calendar we're going to start to see this change. That by the beginning of the third quarter, by the beginning of June, we're going to start to see we're off to the races and people are re-engaging in this market and they're buying and prices are going higher. Now, having said that, do I think it makes sense to wait to engage in this market? Well, let's say you want to buy the median house. The median house as it exists at the end of November of 2022. That house is $425,000. That's come down an average of about $10,000 per month over the past 5 months. So if that house were to, in December and in January, come down an additional $10,000 each month, that's $20,000. If you could save $20,000 on the purchase price of a home, would you wait 2 months? Sure, but it's speculative. And there's something else. Is we wait for prices to come down, interest rates may well go up because we've probably got 2 more interest rate increases on the policy rate. And if the mortgage-backed securities market remains as jittery as it has been through much of 2022, we're going to see mortgage interest rates spiking higher. And I don't know, maybe we get back to that 7.5% range for a couple of weeks. And so you get into contract to buy something at $405,000, but that happens to be the exact same time that mortgage interest rates have spiked higher to 7.5%. Your monthly payment is going to be higher than it will be if you buy the $425,000 house and suffer through 2 months of depreciation at that 6.3% kind of interest rate that you could get right now. So in other words, I don't think a buyer actually comes out in a better position by waiting for another couple months to try to find the exact bottom of the market. Also, in game theory, economic theory referred to as game theory, If you know that you're going to get to a particular point at a particular point in time, you want to beat others to that exact same place. You want to go ahead and pull that decision forward. And in fact, you pull it all the way forward to current time. Why? Because there's decreasing levels of inventory. The house that you want might disappear from the market. It might be the seller pulls it off. It might be the seller rents it out. It might be it never is there again when you actually want to buy it, hoping you're going to get this lower price. Now, I'm not saying that to scare someone into acting right now. I'm just saying that there's actually a logic behind the idea of engaging the market in its current state, because I do not see significant further deterioration in the pricing of this market. We've not been crashing. We've corrected 11.4%. That's significant, but it's not monumental. I don't see us going down a whole lot further from this point, but I do see interest rates could probably jump up and down because interest rates have been volatile. And when you find the place, you put it in contract, you're going to have to, within 2 or 3 days, by your purchase contract, actually apply for your formal loan. And once you apply, you've locked your rate. And so you don't know exactly what rates are going to do on a day-by-day basis. Rates have come down over this past 2 weeks. You could find yourself with a much better rate now, which actually lowers your monthly payment relative to what you might get if you're waiting around to get that bottom price on a house. Now, that's my prediction, is effectively, if we go back and we look at this chart of what has happened over the past 12 months with pricing, median pricing on single family homes, we see this inverted U, or this N-shaped curve. We've gone from 425 on January 1st to 425 on November 30th. I'm not saying the exact numbers, but rather I think we're going to see a pattern which is inverted from the 2022 pattern in 2023. Now, there's a lot of real estate agents out there who have some experience, long-term experience, who are saying inventory is going to go up in the spring because it always goes up in the spring. And there's challenges with that. My prediction is inventory is not going up. It's not going up because what we're seeing are not normal seasonal patterns. We're seeing sellers going on strike, not because it's a slow winter season. We're seeing sellers sitting there looking at their interest rate in a very unusual circumstance. Sellers usually, when asked, don't like their banks, don't like their mortgages, don't like their mortgage payments, but they love their houses. We're seeing sellers right now kind of liking their banks and loving their mortgages. And that's going to overcome a lot of sellers' desires to be selling next year. We're going to be inventory constrained next year. We're not going to see that normal kind of significant increase in spring in inventory. We'll see some increase because there's always more people who are looking to sell in the non-winter months for a wide variety of reasons, job changes, relocations, end of school year, etc. But I think it's going to be less pronounced inventory build this year than what we would normally see. And why do I say that? Look at where inventory is, right? We're not seeing normal inventory flows out of this market right now. We're at inventory levels that take us all the way back to February of 2008. This is not a normal seasonal drawdown in inventory that we've got taking place right now. And so it's not going to be a normal build in inventory that we're going to see in 2023. Now, having said that, we'll know by April or May how well my prediction is going to hold through the end of 2023, because we'll see what's actually going on by April or May with regard to inventory. If inventory remains low, we're off to the races. and we're going to see significant price appreciation in the back half of 2023. And that may start as early as April, that may start as early as March, but it's certainly going to start by the month of June. If you find this video interesting, helpful, please share it with your friends, your neighbors, your colleagues. Please reach out with any comments you have. I'd be happy to engage with you. If you're an investor, or you're thinking about buying, or you're thinking about selling a property here in the Las Vegas Valley, please reach out. I'd be happy to help. And remember, if you're not already, smash the like button and become a subscriber to my channel, where I put out this type of helpful analytical information every month in the form of market updates. Thank you very much. I look forward to talking with you.